reporting season was actually pretty good for under the radar stocks. There was a lot of variability in the market as a whole, but considering our value philosophy, the stocks that outperformed were those that were priced to disappoint. So stocks like McPherson's, Specialty Fashion, UGL, they actually rose something like 30 to 40% on the day, which, like in the case of McPherson's, which is a wholesale distributor, that's because like people just look at the model and think, well, you know, their margins are declining and I guess they're losing market share, but in actual fact they maintain their dividend and reduce debt and increase their margins, so they outperformed. So and in UGL, a contractor, or people have been against most contractors, but really, you know, they managed to surprise as well. So I think we did extremely well in the reporting season. Well, under the radar does have a value philosophy, and some of the stocks that I mentioned that are performing well include McPherson's, UGL, and another one is Cab Charge, which, although it hasn't appreciated much in price, I mean, the big thing about Cab Charge is it's maintaining its sort of dividend yield of around 7%. So this is a classic value stock in that it's come off around 80% in the past few years, but yet its free cash flow is amazing. So we look at free cash flow, which is its operating cash flow of around, in the last half, of around 20 million, and its capital expenditure of around 8 million. So if you contrast a stock like Cab Charge, which still has 30% market share, to a stock like Uber, or a company like Uber, I should say, the ride-sharing company, you know, that's got a market cap of $62 billion. So there's a lot of hype associated with Uber, but it's going to be a long time before they even make a profit, whereas Cab Charge is not only making a profit, but, you know, able to give money back to shareholders. So we see Cab Charge as being, you know, there's a lot of potential there, but in the meantime you're getting a 7% dividend, which is an important part of the equation in the return. Oh, I think with small stocks, they're not analysed very often, so the results are more important because you don't have many people covering them and they don't come out with releases that often. And take Bellamy's, for example, they met their, which is an organic milk provider, marketing group, they met their headline profits, but really what the market's concerned about is their ability to maintain margins, because although they've had a recent price increase, in their outlook statement they said, you know, our margins aren't going to increase from here. So you have to pay attention to the fine detail, especially the makeup of the profit and what they're saying in terms of the outlook statement. So, you know, it's why all our analysts look in detail not only at what the company's delivered in terms of profitability, but what they're saying, and we talk to all the companies in terms of getting further fleshing out whether those expectations can be met. I think with stocks, big and small, they get overbought and oversold. With small caps, there is a bit more volatility because there isn't quite the liquidity or quite the numbers of buyers and sellers, so they can gap up and gap down, which says you've got to be prepared to take profits quicker than maybe you do in the big cap world, but also that there are opportunities to get stocks that are trading on single-digit PEs and have good dividends. So what we look for are companies whose balance sheets are strong, so you know they're not going to go out of business, and can obviously be in a position to return to shareholders via dividends or capital returns.